Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
You're listening to Expert Money Matters with me, Georgina. At Chase Buchanan, our goal is to provide total clarity in an uncertain global landscape. To help you stay connected and updated wherever you are, we've adapted our weekly market update email into this convenient audio format. Here is your weekly market update for the 22nd of July, 2026.
Good morning or good afternoon, depending on where you are in the world. On Sunday night in New Jersey, Spain beat Argentina 1-0 after extra time to win the World Cup. For weeks, England fans sang the usual refrain, "It's coming home." In the end, some of them were right. For the hundreds of thousands of Brits already living in Spain, and the many more planning the move, football really did come home. It just turned out home was Alicante rather than Wembley. The rest of the week's news was less cheerful and rather more connected than usual. A new Prime Minister in Britain, renewed conflict around the Strait of Hormuz, central banks trying to work out whether inflation is cooling or regrouping, and an earnings season beginning with expectations already raised. For internationally mobile families, these stories meet in practical places: the exchange rate on a pension payment, the return on cash, or a tax deadline attached to a property or residence arrangement. Before we go further, a brief note on timing. This audio update was researched and finalised on Tuesday, the 21st of July 2026. Market data, political appointments and policy positions were correct at our research cut-off on the 21st of July. Given the pace of events, particularly in Westminster and the Middle East, some details may have changed by the time you listen. With that said, let's look at the details. Hormuz is back at the centre of the inflation story. The tentative improvement in Gulf shipping has broken down. Since renewed hostilities on the 13th of July, tanker traffic has fallen sharply. Only 4 commodity vessels reportedly crossed the strait on Monday, with no very large crude carriers or liquefied natural gas tankers recorded. 2 tankers were also reportedly struck by unknown projectiles near Oman, while the Iran-backed Houthi movement announced what it described as a naval blockade of Saudi Arabia. This introduces a further threat to shipping routes beyond the strait itself. Both Washington and Tehran have floated charging vessels for transit or protected passage, but an announced threat is not an operating commercial system. There is no recognized tariff, no dependable collection mechanism, and no assurance that paying one side protects a ship from the other. Brent crude remains close to $90 a barrel, sharply higher than a week earlier. And war risk insurance has been quoted in the millions of dollars for a single large tanker passage. Those costs ultimately feed through the supply chain into petrol, electricity, aviation, and freight. For anyone living abroad on a fixed pension, this is worth watching. The same number of pounds or dollars may arrive each month, but energy, food, and travel can still cost more. An unfavourable currency movement can magnify that loss of purchasing power. Britain has a new Prime Minister, and the first economic choices are emerging. Andy Burnham was formally appointed Prime Minister on Monday, the 20th of July, after being elected Labour leader 3 days earlier. His cabinet has now been confirmed. John Healey has been appointed Chancellor of the Exchequer. Ed Miliband becomes Foreign Secretary. Shabana Mahmood remains Home Secretary. Wes Streeting moves to Defence, and Angela Rayner returns as Housing Secretary. Louise Hay has been appointed First Secretary of State and Chancellor of the Duchy of Lancaster, effectively making her Burnham's deputy. The first confirmed economic announcement came on Tuesday. The government plans to remove VAT from domestic electricity bills from the 1st of October. It says this should reduce the average annual household bill by around £45. For the current financial year, the measure is expected to be funded by cancelling the previous government's £1.8 billion digital identity programme. Decisions about longer-term funding are being left until the budget, alongside an Office for Budget Responsibility forecast. That is confirmed policy. Burnham's previous criticism of council tax, his interest in proportional property taxation, and his comments about the gap between capital gains and income tax rates remain indications of his political instincts. They are not yet Treasury policy. There has been no confirmed change to capital gains tax, inheritance tax, pensions or property taxation. Labour's promise not to raise the main rates of income tax, employee national insurance or VAT also remains in place. Markets have reacted cautiously. Sterling dipped modestly against both the dollar and the euro following the cabinet announcement, while government bonds were broadly steady. 10-year gilt yields remained just above 5%, although longer-term borrowing costs stayed elevated. Defence shares moved higher following John Healey's appointment, reflecting expectations that defence spending may receive greater emphasis. For now, it would still be premature to reorganise personal finances around any one possible tax proposal. Central banks are waiting for the data. Across the major central banks, the message is essentially the same. Wait for the data. The Bank of England is holding its main interest rate at 3.75%, although two members voted for a rise to 4% in June. UK inflation was 2.8%. In May, the June figure is scheduled for release on the 22nd of July, the same day this audio update is published, and ahead of the bank's next decision on the 30th of July. The European Central Bank's deposit rate is now 2.25%, with its next meeting on the 23rd of July. Another rise is not the central expectation, but more expensive oil and gas limit the bank's room to become more supportive. The United States Federal Reserve is holding rates between 3.5 and 3.75%. Chair Kevin Walsh has scaled back forward guidance. That may be honest, but it gives markets less certainty, and that uncertainty can itself add volatility. The Bank of Canada held its rate at 2.25% on the 15th of July. It also cut its 2026 growth forecast to 0.7% while raising its inflation forecast to 2.5%, an uncomfortable combination. Earnings season is underway with AI spending under the microscope. Second quarter earnings season has begun, and the major United States banks set a strong opening tone, beating expectations on the back of buoyant trading and deal-making. Attention now shifts towards technology and the wider artificial intelligence ecosystem. The backdrop is resilient growth underpinned by the AI capital spending boom. Unusually, earnings forecasts have risen since the previous quarterly reports rather than being quietly lowered so they could be beaten. Earnings may well be good. The question is whether they will be good enough. Investors are looking beyond the hyperscalers, the very large cloud computing companies operating global data center networks. They are asking how much businesses will spend on AI, where that spending will be concentrated, and whether it will generate a sufficient return. Input costs are the other variable, having moved sharply with energy prices. Earnings revisions also show a cyclical bias across technology, energy, basic materials and industrial companies, led by the United States. Last week demonstrated why expectations can matter as much as results. United States equities fell, with the S&P 500 down around 1.6% and the Nasdaq losing 2.9%. Semiconductor shares dropped roughly 9% as investors questioned the pace and likely payback of AI infrastructure spending. When investor positioning is elevated, even good news can disappoint. SpaceX is a timely illustration of the same principle. Barely 5 weeks after its record-breaking initial public offering at $135 a share, the stock closed Friday at approximately $124, following a succession of declines. That left it more than 40% below its mid-June peak. The last-second abort of a Starship test attempt has not helped. Enthusiasm surrounding a new listing and the long-term investment case are two different things. Newly listed shares can be exceptionally volatile in either direction. Sterling strengthened against both the euro and the dollar over the previous week, although it dipped modestly following the announcement of the new British cabinet. A stronger pound can be helpful if you receive a UK pension and spend in euros. It is less helpful if your pension arrives in dollars and your bills are in pounds. Sterling against the Canadian dollar has been steadier. However, British retirees in Canada face a longer-term issue. UK state pension payments made to Canadian residents remain frozen and do not receive annual increases. Campaigners continue to press the case, but there has been no confirmed change in policy. Exchange rates are notoriously difficult to predict. The practical response is not to guess the best day of the year. It is to understand which future expenses are fixed in another currency and consider holding part of the next few months' spending in the currency in which it will eventually be spent. A quieter risk in private credit. North American direct lending funds raised $16.25 billion during the second quarter, their best quarter in 2 years. At the same time, actual United States lending volume fell by 55% to around $33.6 billion. Managers have more cash and fewer suitable places to put it. That is not a crisis, but it increases the temptation to accept weaker terms or lower quality borrowers. For anyone holding private credit funds or illiquid pension allocations, the headline yield is only part of the picture. Credit quality, valuation methods, and the ability to withdraw money matter just as much. Europe. 2 developments worth watching. Malta is replacing its residence tax programs. New individual tax program rules take effect from the 1st of January 2027, consolidating the existing GRP, TRP, MRP, and UN pensions programs. The 15% rate on qualifying foreign income remitted to Malta remains. However, entry requirements rise substantially. They include a qualifying property purchase of at least €700,000 or annual rent of at least €14,000, together with an application fee of €8,500. Those granted status under the current rules by the 31st of December 2026 can generally continue until the end of 2031. There is one important distinction. Applying by December and securing approval by December may not be the same thing. In Spain, the rental property judgment is not yet being applied in practice. The Audiencia Nacional ruled in 2025 that denying non-European Union landlords deductions for legitimate rental expenses conflicts with the European Union principle of free movement of capital. However, the Spanish state has appealed, and the tax agency's Model 210 instructions remain unchanged. Most non-European Union property owners are therefore still being taxed at 24% of gross rental income. Current professional guidance is generally to file returns on the statutory basis and lodge a separate protective refund claim, supported by invoices for periods still within the 4-year limitation window. And a reminder, the deadline for obtaining new ZEC authorization and registration in the Canary Islands remains the 31st of December 2026. No extension has been announced. Given the approval timetable, this is now a start now matter rather than a December one. The bottom line. This week's risks are connected. A prolonged disruption in the Strait of Hormuz raises energy costs, and that makes central banks more reluctant to reduce interest rates. Higher rates place pressure on government finances and property markets, which can increase political pressure for tax changes. Currencies transmit all of this into the daily finances of people living across borders. An earnings season beginning with high expectations also leaves less room for disappointment, particularly around AI spending. There is no need to react to every headline, but it is a sensible moment to understand how much of your income depends on each currency, whether an overseas tax claim is approaching its limitation date, and whether a residence or business application must be approved rather than merely submitted before the end of the year.
And that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.